Gold has been remarkably resilient. Sometimes it'll be down in Europe and then it goes up in the US. We don't even have to wait a day or two before we get the bounce back. So I don't think we should be, I mean, as an investor, as a person who manages other people's money, I don't think we should be surprised if at some point we get a pullback more meaningful than we've seen. Clear cracks appearing in the US economy, the dollar declining. We're now moving into an environment that is actually an environment where gold should move. So I would say that if you like, the normal gold bull market has only just begun.
Gold prices once again rose to a record high on Wednesday as uncertainty over the U.S. presidential election boosted safe haven demand. Traders also awaiting economic data for cues on the Federal Reserve's policy path. Gold, traditionally a hedge during geopolitical instability, has surged 35% this year, on course for its best annual performance since 1979. Low interest rates have further supported the rally. Adrian Day, president of Adrian Day Asset Management, is more optimistic about gold's potential than ever. Gold has shown remarkable resilience even in a high interest rate environment, and with rates now being cut amid persistent inflation, Day believes conditions are primed for an unprecedented gold bull market. With gold's recent strong gains, he acknowledges that a correction may be expected. However, he sees any pullback as a potential opportunity within a much larger upward trend. Central banks have been buying gold mainly due to concerns over the weaponization of the dollar and as a diversification strategy. Gold demand in China, the world's biggest consumer, plunged by more than a fifth in the third quarter as record prices and a sluggish economy dented consumption, especially for jewelry. Total demand fell by 22% to 218 tons in the 3 months to September, according to Bloomberg calculations based on data from the China Gold Council on Monday. Jewelry consumption tumbled 29% to 130 tons, while for bars and coins, there was a 9% drop to 69 tons. Adrian Day concludes that while a minor pullback in gold prices may occur, it would likely be brief and shallow. He points out that the underlying drivers for gold demand, such as central bank concerns over the dollar's weaponization and economic anxieties in China, remain strong and could even intensify in the coming years, reinforcing gold's long-term upward momentum. We're about to explore the video, but first, make sure to subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
I mean, clearly, markets never move up in a straight line. We all know that. And like a lot of people, I've been nervously awaiting a pullback for a few weeks now. Even a month ago, we could say with the Fed's rate cut in the rear mirror, that was old news. With some stronger economic news, perhaps a pause. Perhaps a skip of the meeting with another rate cut. What I will say, however, is that the pullbacks in gold so far have been very short and shallow. Gold has been remarkably resilient. Sometimes it'll be down in Europe and then it goes up in the US. We don't even have to wait a day or two before we get the bounce back. So I don't think we should be, as an investor, as a person who manages other people's money, I don't think we should be surprised if at some point we get a pullback more meaningful than we've seen. Let's look broadly. Over the last 2 years, as we know, gold has moved up very strongly. Initially, it moved without the stocks moving at first, without participation from Western investors for the longest time. It was moving up because of central bank buying, number one, Chinese consumer buying, number two, which starts, central bank buying has been the last 2 years. Chinese buying has really stepped up since January. Now, both of those two, you could say we might get a pullback. We know why central banks are buying. It's because of a weaponization of the dollar, but they're also diversifying their assets. And so if a central bank says, well, we're now at 10% gold, they might say, well, we can afford to be a little more relaxed about buying more. So it would be natural if you got some kind of slowing of central bank buying. I will say this, however, that when China paused, as you know, in May, they haven't bought June, July, August, or September, and that didn't do much to central bank buying. But central bank buying is very, very broadly based. As for Chinese consumers, they were buying gold because they're nervous about the economy, but they're also nervous about the banking system. They're nervous about the stock market. They're nervous about the real estate market, and they can't buy crypto. So what are they left with? They're left with gold. But now the stock market in China, as you know, in the last month has staged a remarkable rally. And of course, the time to be buying is when things are low. But if you're an investor that's seen your market for 2 years just slide consistently down 40%, you don't really look at the stock market as a safe haven. But now that it's rallied, I think you could see some Chinese buying switch from gold into stocks. So that's a kind of, sorry, I'm going on a bit about this, but what I'm trying to say is that there are reasons to think that some of the buying that we've seen may pause. But my own view is that any pullback we get is going to be very shallow and very short-lived, because the fundamental reasons that gold has been going up, the fundamental reasons that people have been buying gold have not gone away. Central banks are still worried about the weaponization of the dollar, and that is, if anything, going to increase over the next few years, not decrease. Chinese consumers are still worried about the economy and the banking system, so we'll still get support.
BRICS nations, including major powers like Russia, China, and India, are rapidly increasing their gold reserves, shifting away from US dollar-denominated foreign exchange holdings to reduce the greenback's global influence. Adding to gold's rise are political uncertainties surrounding the upcoming U.S. presidential election in mid-November, along with strong expectations for a second consecutive interest rate cut by the Federal Reserve in early November. Over the years, the share of world trade conducted in dollars has dropped, as has the proportion of central bank reserves held in dollars. In the 1990s, about 75% of foreign central bank reserves were in dollars, but this has now fallen to just over 50%. Reflecting a gradual yet steady shift away from dollar dominance. Day believes that, while the US dollar won't lose its reserve status overnight, there are clear signs of erosion. He observes that the dollar's weaponization and the escalating US twin deficits are prompting foreign entities to seek diversification away from it increasingly. Now, let's redirect our attention to a video.
When I think of this, I always think of that overused comment of Hemingway about how you go bankrupt slowly at first and then suddenly. And that's what will happen with an alternate payment system. That's how the US dollar, in my view, will lose its reserve status. Now, is the latter, the US losing its reserve status, going to happen overnight or next year or the year after? No, it's not. But the US, if you look at both the payments and you also look at, the payments and also how trade is paid for, 40 years ago, it was maybe 95% was in dollars. Now that's come down. Still, the overwhelming majority of world trade is in dollars, but they're chipping away at the margin. And if you get Saudi Arabia and, as we saw, Saudi Arabia and China agreeing to do the oil in other currencies, that's very, very meaningful. So all these things are chipping away at the dollar's dominance at the margin. The other part of the equation, of course, is the dollar as a reserve currency, not just its use in trade, but as a reserve. Well, again, in the 1990s, something like 75% of central bank foreign reserves were in the dollar. Foreign reserves meaning not the currency of the country itself. So in terms of German central bank, we're not talking about the euro. In Britain, we're not talking about the pound. So foreign reserves, 75% was in dollars. That number's now down to barely above 50%. So there's already over the decades, it's stepped up in the last few years with the weaponization of the dollar and the huge twin deficits in the US. We could go on about the problems in the US for a long time, but foreigners see these problems and want to diversify away from the dollars. So you've got the payments and you've got the reserve. and the dollar is losing its overwhelming dominance. And until there is a well-established alternative, it's certainly going to remain the world's reserve currency. Once you get, 50% of the trade in currencies other than the dollar, then the dollar starts to lose its dominance very, very quickly. If I can say this, an awful lot of stuff I've seen over the last few months, mark your calendars, October the 24th, sign up here for my special bulletin alert for $1,000 a year. It's just a way to get people to buy subscriptions, frankly. And people should be a little more skeptical of some of these things. It will happen. If there were an obvious alternative right now, I think the US would already be well on the way to losing its reserve status.
De-dollarization pushes investors to flock to gold amid global economic uncertainty and geopolitical shifts. Changing world dynamics, including heightened geopolitical tensions in the Middle East and Europe that have sparked debates about a possible World War III, as well as a global movement toward the de-dollarization of trade through the BRICS platform, has continued to fuel the extraordinary rally in gold. With global moves toward de-dollarization and BRICS nations rapidly increasing their gold reserves, do you think this trend will change the global economic balance? Share your feedback in the comments below. If you found this video useful, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.